Hello and welcome to a brand new show of Markets and More with Sunil Singhania. Last time when we interacted with Sunil Singhania on this forum, markets were in a disarray. But thankfully, in last 8 weeks, there has been an incremental improvement in the economy. There has been a marked improvement in market liquidity, and there has been a dramatic improvement in market sentiment. But is this as good as it gets? Where are we headed from here? And this time Sunil would be discussing his big call with us, and his big call is, some would say it's a very contrarian call. He's of the view, or his firm is of the view, that quality stocks, overpriced high P stocks will not make money for next couple of years. So why is Sunil ready to stick his neck out and predict something which could be criticized also later on if it doesn't work? Sunil, it's a brave call. First, thank you very much for joining us.
Thank you for having me.
I want to start with markets first. Last time when we met, the mood, the sentiment, the flows, everything were pushed. I mean, things were really in a mess. Now, economy has improved only incrementally. Liquidity has improved rather substantially, but the market mood has changed dramatically.
So, you're right that we have seen a very challenging environment in both the economy and the liquidity. However, one thing which has changed is now the confidence that the government means business. So whether it is a few FDI changes, the big corporate tax rate cut, and also significant announcements post that, it gives a confidence that, the government will do whatever is needed to bring it back on track. There have been major announcements like, strategic sale in PSUs, where there have been a multiple advertisements, inviting consultants and bids for a few PSUs. So I think there has been that confidence that there is a move towards pushing whatever it takes to bring back the economy on track. And it has also got coincided with a fairly robust international environment. Actually, if you see, Nikunj, most of the global markets are at their 52-week high. If you see the year-to-date returns for Dow, for NASDAQ, for the German index, for some of the other, the Brazilian index, they're all like 25, 27% year-to-date returns. So I think that has also helped the mood. And the most important thing is the spate of negative news flows, which we were seeing continuously. I think that has got settled.
Your big call is that your firm believes that quality companies will give no low or negative returns for next 5 to 10 years. Now that's a very powerful kind of analysis. So what you're saying is that, look guys, there's a bubble in the market and it's about to get pricked.
So I think I'll just put a disclaimer. It's not that all quality stocks will have this or that the overall market is in a bubble. I think what we are trying to say is that, yes, it makes sense to have quality stocks in your portfolio, companies which have high ROEs. But as all of us have been taught, and it's been proven in the world of investing for not only years, but decades and centuries, that ultimately a stock is a stock which will give you returns. It's not a company which is the best, but which might not give you returns. And how do you classify whether a company is a good stock or not? And there are various methodologies to it. So you can give a premium to quality, but that premium cannot be an infinite premium. So a company which can trade at 30 PE starts to trade at 40 and then 50 and then 60 and then 70. There has to be some place where you start to say that, no, now, you have reached a scenario, you have reached a valuation matrix where from here on, you can't make returns. So I think this report is just highlighting those few stocks where PEs have moved up like 70, 80 times on a trailing basis. And we're just trying to use various, you can say analysis to justify that it is going to be very tough if they continue to grow at the rates which they have grown over the last 5-10 years to make any money. So, unless you have a view that some of these companies might grow really, really fast, then it's a separate thing. But if they continue to grow at the same rate, then it's going to be very tough to make money in this.
Okay, just to break it for viewers, the data point will just come up on the screen, which tells you that what are high PE stocks, and this is the data which we picked up from Sunil's firm study, that where P multiples are trading north of 50 times or even nearing as high as 100 times. 100 times, that is the P multiple for some of these stocks. Sunil, we are in a very differentiated global environment. Interest rates are low, growth is not very great. The hunt for yield is very high. Nobody can predict what will happen to world after 3 months. Forget about talking about 3 years. So the trend of buying these high PE stocks is backed because of what is happening in the world. What makes you convinced that the trend will not extend for another 2-3 years?
No, so that risk will always be there, Nikunj. I would again go back for people who have been investing in the equity market since maybe 2-3 decades. We have had many such instances, like even during the dot-com bubble. The bubble lasted for maybe a year or two, and Warren Buffett very publicly said that he did not understand it, and he did underperform for 2-3 years. The same thing happened in the power and infra side in India, where from 2006 to 2008, you are almost in a bubble kind of territory where, the moment you announced a power plant, your market cap used to go up by a couple of $1 billion. And I would say recently you had this kind of a phenomena even in the pharma sector in 2016, where companies started to trade at 40, 50 PE multiples on a forward basis. And we have seen what has happened. So these risks will always be there. I think as an investor, what we are basically looking at is, whether you have reached a stage where the risk reward is definitely not in your favor. Now, whether you can go wrong for 3 months, 6 months, 1 year, that can always happen, because there are a lot of other factors other than fundamentals which drive equity prices, whether they are technical factors, whether they are flows, and so on and so forth. So that risk is always there. So I think the idea of this study is to just make people aware that you have to keep this in the back of your mind before you take a big call.
Okay. One of the reasons why some of these staples or engineering companies or these quality companies have done well is because growth has been very volatile. For those who made a case of economic recovery in 2015, 16, 17, 18, even 19, they've got it wrong. Now, economy is not going to come back in a hurry. That's what all high frequency data is indicating. So what happens? I mean, you should take risk in equity markets, but if the economy does not support, one is saying, look, I'm better buying a 15% compounder rather than buying for something which could be a multi-bagger.
So 2-3 aspects to it. One is any equity investor who invests has to be optimistic and positive about the economy. So if the view is that the economy is not going to come back to a 6, 7, 8% growth rate, then anyway, I think India's PE multiple will deflate. Second is, you talked about these companies growing at 15% plus very consistently, but that is exactly where the surprise is. So if you go back last 9 years where the nominal GDP growth in India has been 13% because inflation was almost 6-7%, these companies have grown below the nominal GDP growth rate. Now with inflation at 3%, it's very hard to believe that the nominal GDP growth in India over the next 5-10 years is going to be anything upwards of 10%. Okay. So in that kind of a scenario, these companies are also logically not going to grow higher than the nominal GDP growth. Maybe some companies might, but as a basket, it looks very, very tough. And the third thing is, our view is that the economy the economy surely should come back. It might take 2 months, 3 months, but we are very optimistic that the economy should come back on its growth trail, which is when other companies, other sectors will start to demonstrate some stable and faster growth. And that is where the investors would start to again move, maybe from some defensives to companies which are growing faster. And this happens all the time in the markets, and we have seen that. The most important thing is we've did an analysis globally, and there have been no instances in the world where so many companies have traded at more than 50 PE for more than 5 years. In fact, as we speak in the US, over the last 15 years, there have been only 3 companies which have traded more than 50 times PE for more than 5 years. And these are companies which are like Amazon and, some of the
most of the blue chips
companies and all. So it looks very tough that this outperformance continues for a long, long time.
Okay, so what Sunil is saying, and this is just for the benefit of our viewers, that markets, they follow a cycle. If you look at how markets have followed a cycle within India, in last 20 years, it was the TMT bubble, then came the infra cycle, now it's the quality cycle. What Sunil is saying is that we've had a good run in some of those high return, high ROE businesses, but price is what you pay, value is what you get. You are paying a high price and not getting the exact value which an investor should get if you buy some of these values. I was reading a report from Harvard Marks a couple of days ago, and he said, look, bubbles have happened in quality companies also. 1960s and 17 US blue chip stocks reached that disproportionate territory where they did not make money.
No return for 16 years.
Yeah, so it's not that just because you're quality, just because it's a quality business, it will always make money for investors.
That would have been the case. Portfolio managers would not be needed. You just buy the top 10 best quality companies and just forget about it. So I think it's worked. But even in India, Nikunj, we get carried away with a few of these companies. But there have been multiple examples where some of these quality names have disappointed big time. You had the largest pharma company, Sun Pharma, from 2016 to now is down 60%. Yeah. There have been other companies across sectors, whether it's been on the FMCG side, there have been companies like Snyder and Alstom on the engineering side. There have been FMCG companies where the moment you have 2-3 quarters of slowdown, you have had a massive pull down as far as the prices are concerned. In auto, the same thing has happened. So once the growth comes, you start to extrapolate that this is going to be there forever. And in a lot of these companies, you have 1 or 2 or 3 quarters of disappointment. And that is when the investors start to realize that, you're paying too high a premium for a so-called faster growth.
My Philips air purifier kills 99.97% airborne pollutants. How much time will you take to get one home? Innovation in you. Philips.
The wheels in motion, we set the fire. You know it's going down.
To avail Movies Now, M&X, and Ramadi Now at just 10 rupees, call your cable operator or DTH operator right now.
First, we've understood where the valuations are. Now let's understand what is available. So according to your analysis, HUL and Nestle, the combined profit of HUL and Nestle is available. The peak profit is about 7,600 crore. I'm keeping the numbers away for rounding off. And the current market cap is about 6 lakh crore. In 6 lakh crore, currently, you're getting the entire steel sector, the entire metal sector, and the entire cement sector. And the combined profit for the metal, cement, and the steel sector was about 70,000 crore plus. What are you trying to indicate here?
No, so I think it's just to reflect that what can you buy. Just out of context, suppose if Hindustan Lever were to stop operations in India, so you would have to shift to some other soaps or some other detergents or some other shampoos. It's not going to be the end of life, But for one Hindustan Lever, you are able to buy almost the entire core sector in India. I think it's not a one-on-one comparison because obviously different sectors will have different kind of valuation. But it's just to make people think that the disparity in the valuations has reached a stage where you're paying like a 10-time multiple to a perceived quality company, which is growing at the same rate as the nominal GDP. And all the other sectors which you mentioned have also typically logically grown in line with the nominal GDP, So it's just to sort of kickstart your thinking that you should be aware of these two companies, which are not core to any economy, what valuations they are trading at compared to what the other alternatives are.
But with the steel company, with the cement company, with some of the cyclical stocks, you're also inheriting a debt. The promoter allocation, at least at promoter groups in India in last couple of years, has been absolutely pathetic. Promoters have gone in their capital allocation, both in the balance sheet level, even at a company level.
True.
So that's the risk which cannot be undermined.
100%. And I think when you are looking at the current market cap of all these companies in the core sector, whether it's steel, cement, building material, I think that is already factored in. So we are not looking at companies which are undiscovered in the sense of their issues either in the company level or in the promoter level. Yes, these companies have debt, but we are not looking at EBITDA levels. We are looking at the net profit levels. On EV EBITDA, these companies will trade at maybe 4 or 5 times compared to maybe, 100 times or 70 times for Nestle and Hindustan Lever. And ultimately, these are companies which are going to generate a lot of cash. But by the nature of their business, they will need to spend on capex to expand capacities. So obviously, their Ps are not going to be anywhere closer to 70, 80.
Yeah, other important technical factors which we normally think is technical but is important in terms of market behavior are ownership patterns. Again, some fantastic data there. According to Sunil's firm study, mutual fund and insurance, their holding patterns have completely got skewed in favor of top 50 companies. And the lower you go, you would actually see, because the market in the mid and the small cap space have been volatile, the ownership patterns in the non-top 50 companies and even below that, the institutional holding patterns have got completely diluted. It's crazy, isn't it? I mean, institution guys are supposed to be the smart guys who always cherish value. They're selling value and they're buying higher price stocks.
So, if you go back again in history, the foreigners were normally, 90% in the top 100 companies. But the domestics used to be like 50, 60% in the top 100 companies. And they were more broad-based because they were on the ground. They could research these companies, they could meet the companies. And therefore, the performance of the domestic institutional investors used to be always better than the foreign investors. And that was one selling point when I was on the mutual fund side, when you used to go and meet foreign investors. That used to be a selling point, that we are on the ground, we'll create alpha for you. But because of some reclassification which SEBI has mandated, and also because of the reason I said that, performance has come in this company, so more money is coming in those funds, and those funds are again buying this company. I think very interestingly, from 50% of your corpus, incremental inflow going into the top 100 companies, now almost 90% is going in the top 100 companies, and only 3% is being invested in companies beyond the top 200.
The reason for it, because these companies, these promoters, these businesses have not performed. They've struggled in a down cycle. They've done all kind of, a stupid capital allocation. And the reason why big have become better is because the reason why big companies have become giant companies is because they're better.
So there is this perception that smaller companies have had more issues on capital allocation and also on things which are not completely sort of transparent. But actually, if you look at the list of names and companies where there has been the biggest capital destruction, you will find that most of them were in the top 100 or 200.
Okay.
Yes, there have been some smaller companies. Now they have become smaller, but 90% fall, 95% fall have been in companies which had market cap of $10 to $20 billion only 2-3 years back. And you will have some finance companies in that, and you will have a lot of other manufacturing companies in that. Other thing is, we are not saying that you buy anything which is small or beyond the top 100 just because it is beyond the top 100. I think that is where also you'll have to do your research. And we should not forget the fact that a lot of these companies which are now large started off with being very small. So Bajaj Finance, when we first bought it, had a market cap of 400 crores. Yeah. It was a small cap. Or Eicher Motor had a market cap of like 350, 400 crores when it was, when it started to move up. And now they are classified as one of the bluest of blue chips. So a lot of these companies have had their cycles. In fact, the complete Nifty basket has changed. I think only 5 or 10 companies remain from where they were maybe 20, 30 years back. So a lot of these new additions have been companies which have had great management, and they've started small. So you have two options. Either you wait for 15 years when the good smaller companies become large caps and then invest, or at least, keep your fundamentals intact. But at the same time, be a little bit more pragmatic in saying that, when I am buying a shares of a company, I'm becoming a partner in the company. Will you like to be a partner in a company which is making 100 crores, which is valued at 10,000 crores? Or you would like to be a partner in a company which is making 50 crores, but which is available at like 250 or 300 crores of valuation? I think the choice is what the investor has to make.
Sunil, every time I've interacted with fund managers, they always tell me about some good businesses they've invested in the past and how they've become big. What they don't tell me is that where are they investing now and which are the businesses which can become big in the future. Like Eicher, Bajaj, you've invested in them, but that's yesterday's story. They now may fall in the quality bubble category. So which are the ones where you think you have a knack of identifying good businesses? Where are you identifying good businesses right now?
Very logically, if you think, what is happening is the brick and mortar businesses are not expanding capacities. Yeah. One, because right now their performance is not good. Second is there's a perceived risk, so they are not able to raise equity at the valuation they would want to raise. debt is expensive because of the problems which the banking system and the financial system in India has gone into. And therefore, no one is wanting to increase capacity. Now, it's a similar situation to what existed in 2002 and 3. And when the economy started to move up, so there's a disclaimer, ultimately for us to make money, the economy has to come back on track. When the economy comes back on track, these businesses, these companies will have to meet the additional demand with the same capacity. And new capacities take time. Second, other interesting factor we have to note is that you mentioned that there's a lot of liquidity in the global markets. Interest rates are so low. Even in India, G-Sec yields are now down to 6.4%. The way the trend is moving, I think there is a possibility that it might go down a little bit more. But it's not being transmitted. Once that transmission happens, companies which are borrowing money or which have debt will be beneficial, because their cost will go down. And in fact, companies which are neat, clean, which have excess cash, their net profits will go down because a big portion of their profit is also coming from other income. So in fact, one thing which we have to also note is that these FMCG companies which are trading at 80, 90 Ps, even the other income on their extra cash which they carry on their balance sheet is being valued at 70, 80 times. So we have to keep that also in mind. So I think these core companies will be the ones which will start to benefit from both. And hard assets start to get more valuable in a falling interest rate scenario. That again is something which we have to keep in mind. So I think what we are trying to focus on is whether there are companies which are even in this kind of a scenario growing. The growth might be 10%, 12%, which have respect for equity. So we have a hurdle rate that 15% ROE, has to be that hurdle, because we don't want companies which are destroying capital. And then you have to have some confidence on the management that they're not going to misallocate incremental capital.
What is the hurdle for buying the P multiple?
Right now it's 15.
Okay, so you're buying stocks which are growing at 15%, return on equity is 15%, and the P is 15.
Less than 15.
And genuine businesses are available.
So what we're doing is 2 out of these 3 should be present today.
Okay.
And 1 should be visible not more than 1 year down the line.
Okay, are you fully invested in this market?
So in the first fund, we are almost 85% invested, which is more a multi-cap fund. The second fund is ongoing fund. We are almost 40%.
That's a small cap fund.
That's below $1 billion market.
So you will not buy staples in that? You will not buy engineering companies according to your own analysis?
No, so actually, there is a big disconnect. Even in the consumer pack, the larger companies have kept on performing. The smaller companies, no one is looking at it. And I think some of those companies have started to come into that 17, 18p kind of a multiple. So maybe if you just go 2-3 months down the line, some of the businesses might be available there.
So it's time to do hard work. Now money will be made if you understand investing, or you're ready to do hard work. Those plain vanilla investing where you bought those 8-10 stocks and sat on it, I think that easy, lazy trade is over according to you.
Passive, lazy, complacent trade has worked. People who, like us, who worked very hard to make money have not made money. Hopefully that would start to play on.
Well, I wish you all the best. It's been a very engaging conversation.
Thank you.
We've talked about something which frankly nobody is speaking on the street. Maybe they're scared, or maybe they are
I don't know. As you rightly said, there is a big possibility that this might not work out. And as I said, now everyone has a view. So
it's all about taking a analysis.
Yeah.
Investing is all about making a scenario and then doing your best.
And sticking to what you believe in.
Of course. Good luck and thank you for joining
Thank
us.
you.
And that's it on this edition of Markets and More with Sunil Singhania. Thank you for tuning in and thank you for watching the show.